All right, let's get some insights on the news that's shaping the markets. And for that, we welcome in Burns McKinney, Managing Director, Senior Portfolio Manager at NFJ Investment Group. Burns, thanks so much for joining us. Great to see you.
Thank you.
So as I was saying at the top of the show, not a whole lot of action today, but we are still seeing the S&P 500 above 5,500. Dow has turned negative, but overall the big question is, can the momentum from the first half of the year continue in the second half of the year? What do you think? Is there room to run for this market?
Well, first of all, oftentimes the best way to predict what's going to happen in the second half of the year is just to look at what happened in the first half. I know we as investors and pundits always like to call a turn, but typically speaking, momentum does carry the day, and so we should probably expect to see things do a little bit better going forward. Probably the biggest driver that could post continued gains later this year would be the fact that most of the recent reports show inflation continuing to come down, and as that happens, as you see jobs reports like we've seen today, and like we'll see a little bit more data later this week showing no real breaks in the economy, but nonetheless a slowing down of the economy, that should give a Fed that has been very data dependent thus far the ability to move forward with possible interest rate cuts later this year, which could be the next catalyst down the line for the equity markets.
So is this rally dependent on the Fed actually cutting rates, and what happens if the Fed doesn't actually cut rates? The market's now pricing in, 2 cuts. The Fed said 1. Powell yesterday said he needs to kind of wait and see. So does this rally stall out if those cuts are pushed to next year?
I wouldn't necessarily say it stalls out, but it would definitely lose one of its primary supports. I think you do have a market for which they finally converged on the Fed's dot plots with the expectations. We came into the year earlier this year with the expectations of 5, 6, 7 rate cuts, and I think the markets have kind of gotten a little bit of a dose of reality, and so they are in place there, but. That said, in many ways, things are a little bit priced for perfection with respect to, what the Fed does later this year, given the fact that, if you just look at valuations alone show that you have the S&P right now trading at about 22 times forward earnings, which is, more expensive than it's been about 80% of the time this millennium. And so you don't have valuation on your side. And so I would argue the markets are a little bit reliant to this day, on the Fed having the ability to at least cut rates once or twice this year. That said, what matters over the long term for investors who are looking out 2 and 3 years is not necessarily what the central bank does this year with respect to, does it cut once, does it cut no times, does it cut twice, but rather where they end up ultimately settling with respect to interest rates.
All right, so let's talk about areas of the market that you find attractive right now, especially given valuations. You say value equities are ready to turn a corner. So starting with just your sector picks, where are you finding value?
Some of the places we're looking at, we're looking for places that you do have secular trends working in your favor. The industrials are a fairly interesting space, given the fact that, you have, we've talked 2 or 3 years ago about the big infrastructure plans, but that said, a lot of that money is just now starting to go out the door. So you have, a lot of spending boost from infrastructure spending. You have, just with geopolitical turmoil around the world, that should give a little bit of a floor to defense spending, and valuations really aren't stretched there. So that'd be one place to look. Kind of an interesting place to look as well for investors that are looking to kind of maybe straddle the line between defense and offense is healthcare. The healthcare stocks really aren't trading at demanding valuations right now, and it's one sector for which you have both demographic trends and just the consistency of spending on the defensive side. But that said, it's also the sector for which going back over the last couple of decades where you've had better earnings growth than any other sector. So you do get an opportunity to kind of take advantage of growth if you're wrong on that defensive positioning.
Okay, so in terms of a few names that you like, Honeywell. So you said industrials. There's your industrial name. Why Honeywell specifically?
Sure thing. Yeah, that they really they stand to benefit from a lot of what I was just speaking of. You've got a name there that for years people thought of Honeywell as being a little bit of a miniature GE. They have a reputation for having great management. It's trading at it's had a little bit of a tough 2 or 3 years, and so as a result, you're getting Honeywell at a discount to its industrial peers. You have a name that's been extremely shareholder friendly. They've grown the dividend by nearly 10% per year over the past decade. And going back to the story of secular trends driving names, you have a name that a lot of the spaces in which they operate are very well positioned. They provide cockpits control systems for jets, which is an area where the increases in air travel should give it a little bit of a boost. And they're one of the dominant players in building controls, smart thermostats, which makes it a play on both the Internet of Things and really specifically energy efficiency. So that's one we definitely like.
All right, we only have about 30 seconds left, but I know you have a few other picks. You have pest control with ROL. You have Crown Castle CCI also as a pick. Any just quick thoughts on the two of those? One that we are getting some looks at would be Rollins, which most folks don't know the name Rollins, they just know the name Orkin. They're one of the two dominant players in pest control, and it's trading relative to the market as cheap as it has in the last 10 years. And it's the type of business for which most of their revenues are recurring, they're contractual, so you do have repeating earnings, and they do the dirty work that no one else really wants to. It's the type of thing where you pay a little bit now or you end up paying a whole lot later when it comes to termites and the likes thereof. All right, we have to leave it there. Burns McKinney, NFJ Investment Group, thanks so much for those picks and for your insights. Appreciate you being here.
Thanks for having me.